Hi there, eToro. It is Monday, the 10th of July, and that means it's time to take a look at what moved the markets last week. I wanted to kick off today's video talking about correlation. So at the moment, correlation is fairly low across stocks in the stock market. Correlation is the tendency for stocks to move in the same direction. Highly correlated stocks mean that they're moving in the same direction and would correspond to a value of 1. Very low correlation would correspond to a value of 0 and mean that they're moving in all kinds of random directions. So what this article is talking about is the fact that at the moment stocks are not correlated very much. And if we look at one of the measures of correlation, so here we have an index that represents correlation, we can see that correlation has been falling off of a cliff through the past few months. Now, one analogy that I find quite useful when it comes to stocks is that of weather. So if it is very nice and sunny outside, there is a tendency for just about everyone, if they can, to go outside and enjoy the sunlight. The people are very highly correlated in going outside. And if the opposite were to happen, if the weather is awful and it's raining, then just about everyone will move inside. So people are highly correlated in their actions. If the weather is somewhere in between, you would expect a mix of people to be inside and outside, depending on their preferences and the type of people that they are. The same thing tends to happen with stocks. When things are very good and there's a lot of euphoria in the market, people tend to jump into the stock market, driving just about everything higher. Similarly, when there's a lot of fear in the market, like there was through last year, stocks can become very correlated because everyone is climbing out of stocks because they're terrified and they want to preserve the value of their money. Through 2023, the correlation in stocks has diminished quite significantly. And usually this would be a good thing for stock pickers because it would mean that good companies are rising and bad companies are falling, and all you need to do is be the kind of person that can do the research and find those good companies. However, the article goes on to say that that's not actually the environment that we have right now. If we look at the S&P 500, we can see that year to date, so from the beginning of the year until now, it's risen nearly 15%. But this hides what's really going on in the stock market. So I'm not sure if you know, but there are indexes that are market weighted or equal weighted. The S&P 500 is a market weighted index. So this means that the bigger a company in that index, the larger impact that company's share price has on the index overall. So if you imagine the S&P 500 is one giant pie chart with individual companies being the slices of that pie, the bigger companies are a bigger slice, and if their share prices move by a percentage, it has a much bigger impact on the overall pie. So the S&P 500 has risen nearly 15% year to date. However, if we look at an equal weighted version of the S&P 500, so this is a version of the S&P 500 that's been calculated such that each company has an equal share of that pie overall, we can see that this orange line, which represents that ETF, has risen only 4.5% year to date. The long and short of what I'm saying is there is a low degree of correlation. It might seem like a stock picker's market, but it's not really. It's just the biggest, most powerful, highly profitable businesses that have been pulling indexes higher, while at the same time mid caps and small cap companies tend to have suffered. I quite like this quote from this same article. History suggests that the average stock will catch up with the mega caps over the next 12 months. I like it, but I don't necessarily agree with it because it is very optimistic. It's saying that the rest of the market is going to rise to meet what the mega caps have been doing. However, I think that there is a good chance that the mega caps fall to meet the rest of the stock market instead. The reason I think that there's a decent chance of this happening is interest rates are still high, global growth is not great, inflation is still high. So while I would love it if the rest of the stock market carried on rising to meet the mega caps, I'm not so sure that that's the way that this is going to play out. All right, moving on to what happened last week. In terms of macroeconomics, there were two big events that moved the market. The first of these was ADP non-farm employment change data that hit the market on Thursday, and this came in significantly higher than was expected. And this spooked the market because if the Fed thinks that the labor market is too strong and is going to keep inflation high, it will, of course, be hawkish and raise interest rates further. The thing to note about this particular number is that it is incredibly volatile. And if we look at the details, we can see that leisure and hospitality, this huge number, is a very large part of this blowout that we saw last week, Thursday. This trend to see an explosion in the leisure and hospitality area is not just US specific at the moment. We are seeing it in the UK and Europe. In fact, in the UK, it is one of the biggest drivers of inflation right now, but it also tends to be seasonal. People hire employees to work at their restaurants during the busy season, to work at festivals during the summer months, to man their planes and hotels when people are going on holiday in summer. So a highly seasonal pool of workers within that group. The market had a bit of a knee-jerk reaction to this number and stocks fell. However, the very next day we saw the slightly less volatile non-farm payrolls come out, and these came in below expectations, and that allowed the market to recover some of the losses from the previous day. We're starting to see more and more impacts of high interest rates in businesses through economies. I think that the first area that was hit were mortgages, because mortgage rates rise just about immediately as interest rates rise. But now we're also seeing a drop in volumes of loans of other types because the rates are just so high that companies and individuals are less likely to borrow. I expect to see more headlines around the impact of interest rates through the rest of this year. It's no more just speculation. The impact is starting to be realized, and this is one of the reasons that I think that we might see a shaky second half of the year when it comes to the stock market. I also very quickly wanted to talk through two companies in my portfolio that have done very well through the first half of this year. The first of these being Facebook, and you can see that through the pandemic, Facebook's share price rose to just about $400. And then as it started announcing the metaverse and the cost impact of that, the share price began to fall. The share price bottomed out around $90. And since then, Facebook has done a number of things to make investors believe that the company is not going to collapse in the next 6 to 12 months. So one of these has been the enormous number of layoffs that they've enacted, but also they've dialed back the expenses, the amount of money that they've been pumping into the metaverse while trying to squeeze a bit more juice out of the various platforms that they already have out there. Long term, I'm not sure about the future of Facebook. 10 years from now, I don't know if it will still exist. I think that it is still a high quality company right now. However, because it's looking quite expensive, you can see that it's just climbed and climbed and climbed through the past few months. In terms of valuing the business against the money that they're actually bringing in, the profit that they're making, it's looking quite expensive. So I think that on eToro at least, I'm going to exit all of my Facebook position somewhere within the next week. The second company that I wanted to talk about is Rolls-Royce, and this isn't the car maker. This is the company that's involved in aerospace and defense. So they make engines for planes, but they also do a number of other things. And you can see that as we entered the pandemic and people realized that planes were going to be spending a lot less time in the sky, the share price of Rolls-Royce fell off a cliff. Now, there were a number of other things going on at Rolls-Royce at the time. They'd been going on for several years, and the company had been struggling a little bit. You can also see that the share price stayed at a very depressed level for a long time because people weren't flying for just about 2 years. And there is a very strong correlation between planes in the air and the amount of money that Rolls-Royce makes. The reason that I like Rolls-Royce as a turnaround play is because there are very few companies in the world that have the engineering know-how, intellectual property, etc. to do what they do. They've done a number of things to tighten up the operations of the business. They've installed a new CEO, and they've been able to manage their debt quite well, even though there was this enormous drop in revenue through the pandemic years. Now that the pandemic is in the rearview mirror, what can we expect from Rolls-Royce? Well, I've already spoken about how demand for travel and leisure has been one of the major drivers of employment in the US, inflation in the UK and the EU, because of the number of people that are being pulled in to that particular sector. And I'm sure some of you will have noticed the massive increase in plane ticket prices that have been happening through the past 6 months. The long and short of it is that demand for airlines and flights correlates to a very good near-term future for Rolls-Royce. Rolls-Royce also has their fingers in a number of other pies. One of those larger, more interesting pies is the development and building of small modular reactors. The company is leading a consortium of businesses that are trying to get this off of the ground in the UK. Around the world, there are a number of companies working on this type of challenge at the moment because SMRs are a way to build and deploy nuclear reactors much more quickly than was historically possible. Rolls-Royce has been able to raise a lot of capital within the UK and also to get government grants to help them to develop this capability. They've just finished stage 1 of this preparatory work, and they're moving into stage 2. This is not a short-term thing. It's going to take many years for them to develop. and then hopefully deploy not just in the UK, but around the world. All right, what about the week that we are currently in? Well, if you look on screen, you can probably see the two big things that are going to be the market movers this week. The first of them being CPI out of the US. CPI being that lagging indicator, that consumer-driven inflation number. And then on Thursday, we're going to get the PPI number, which is the leading inflation number, the number that leads the CPI number generally. Everyone is very interested to hear what the Fed is going to say about the rate hikes this month. But even more importantly than that, they want to know what the Fed is going to do in the near-term future. And these data points are going to be the things that drive the Fed's decisions for those upcoming rate hikes, if they happen. In addition to this, we are at the very beginning of earnings season once again. So we're in the week commencing the 10th, and you can see that JP Morgan is going to report earnings this Friday. That'll kick off the earnings season, and we can see that there are a number of other companies, banks, and some big tech companies that will report earnings next week. Expectations for earnings are not very good, but should they come in below those expectations, I think that's when we'll see some volatility in the market. All right, that's it for this week. I hope you have a good one. Goodbye.